Rohr here with an early concise highlight on Wednesday, August 26, 2015. It is currently 7:45 a.m. U.S. Central Time. And in addition to this being only the concise view of the S&P 500, we are going to take a broader look at the technical trend projections, including the ultra long, to show how the market, in spite of the recent turmoil, remains in a bullish trend overall. But first, let's take a look at the macro influences. And what we've had is mixed data of late, but with the Chinese influence waning. And what we mean by that is overnight, the Shanghai Composite, which had sunk below 3,000 on Tuesday, that was a key level, weakened somewhat further, not disastrously so, but in the meantime, the S&P managed to rebound overnight. So what we have in the other data, though, is the whole idea that mixed data is yielding to somewhat stronger data. On Tuesday's German GDP coming in about as expected, but the exports were good and the IFO was better than expected. U.S. house prices were a little bit weaker, but everyone knows that's off a multi-year bulge there, and Richmond Fed was quite weak yesterday as well. But coming in Wednesday morning, the Japanese Corporate Service Price Index stronger than expected, UK CBI reported sales stronger than expected, and U.S. durable goods orders quite a bit stronger than expected. Some pretty healthy pluses where minor negatives had been expected, and upward revisions to last month's very strong figures, as opposed to what sometimes can be disappointing downward revisions. Now, it also pays to remember, though, that's the last of the really critical data, not only out of the U.S. today, but pretty much into tomorrow morning. There's not a lot of offshore data on Thursday before we get to U.S. GDP. And Friday, of course, we're going to have a lot of the first phase of the major important end-of-month data. So a lot yet to digest this month and this week. So what does all this mean to the markets? Well, the U.S. obviously having been weakened by anticipation of some real weakness in China that turned out to be only moderate further slippage. The weakness late yesterday, as you can see here on the chart, back below this key level in the low 1900s, left it down, back testing the late reaction low from Monday, down around 1871 and closing in that area. However, the degree to which it was already upbeat in spite of the Chinese data left it up at around 1900 early, and presently it's up 47 at 1920. Now this is very important because it makes this look like a false failure, so to speak, that the failure back below this key low 1900 area, the upbreak from the gap higher yesterday morning at 1906, the Fibonacci 25% retracement also right around the 1904 area, etc. So we were looking at 1905 to 1900 as support. Looked pretty bad yesterday late, but reinstating it today and knowing there is no other data out today, and the Chinese influence, most importantly, is now being shaken off, is important. Now, these markets are moving in big drafts, as you obviously know after the last week. So with it back above 1905 to even, there really is not all that much till the Fibonacci retracement up at 1943 and the bottom of the gap from the bounce after the sharp gap lower Monday left a high at 1950, and you can see how important that is as the market neared it yesterday at the high early, not being able to get through, left it back under pressure. And we end up with the market actually ultimately needing to get back above the close, the whole gap lower, and you'll notice that this Fibonacci halfway retracement, this is of the whole move down on the contract for September. That's from the high up at 21.25. That's from back in May when the lead contract made a 21.32 all-time lead futures contract high, all the way to the trading low. The halfway retracement's right here at about 1978. And the reason that's important is 1970 to 80, as we'll revisit on the intermediate term chart, was a pretty big historic congestion from back in December and January. Much above that, it's interesting that the Fibonacci 2/3 is about 2012, where 2015 was a key down break. And the higher resistance that's important, of course, was all that congestion out of the March and July lows up at 2036 to 40. Now, admittedly, that's getting the cart a bit ahead of the horse, but we want to make sure we laid out all these extended levels. And of course, the low on Monday at 1831 was fairly not near the 1813 October 2014 Ebola crisis low. So these are the kind of factors we're dealing with in these wide-ranging markets, but for now, looking pretty good, back above the low 1900s. And that pretty much does it for the short-term view of the S&P 500. And this is your S&P 500 monthly high-low close, which goes all the way back to 1982, but obviously from those kind of trading levels, the market superseded it initially with the run-up to the 1600 area back in 07. But the major low from the 08-09 crisis was the rather spooky 666, generally speaking. And the overall upward channel from that, using the lows from both 09 and October 2011. Here's your 1068 pullback low again. You look at this heavy black line, and the market actually accelerated out above it from where? It accelerated out above it from the 1777 area. Now, what's important about that is you look at this much broader channel, and it's not really productive to try and look all the way back there on the chart, but this is from the major 1987 low across the 2009 low, and the commensurate channel also came in November of 2013, right about that same level, the upper 1700s. What is then increasingly important about that is the channel up, the adjusted channel, incorporating the high from the April 10th, low 1200 area, and then the more recent highs up in the 2100 area to somewhat above it. Those are the points we use to set the reference line for the projection up off that 1068 low once again. And that, which is now the broadest bullish channel, not just, the more aggressive channel the market broke at 2015 last week, but the broader bullish channel that is projected up off of the 1068 low from back in October of 2011, that this month is at 1785, next month 1800 area. And along with the Fibonacci levels at 1765 and low 1700s, and this last pullback as the market was accelerating and across several months had a pullback down to 1732, the mid to low 1700 area to decide whether you've really broken down in a meaningful way below this upward channel in the next month is the key arbiter of whether the S&P remains in a broader upward trend overall. So as bad as this has looked, and this is pretty ugly, we as the financial electronic press has been reporting, we haven't seen breaks like this since 2008. And it gets kind of scary. Even the Ebola crunch break lasted a week and a half and you were right back up. We think this market could be turning more bearish in the intermediate term, but unless it's below the low 1700s, you're probably setting up a retest of something up around upper 1900s to low 2000s. And that's the broader view, and that's why the S&P remains in a bull trend overall, regardless of the recent travails of the market.